For the handful of people out there who have not read your book, can you please just summarize the main ideas?
I think the main ideas that struck people, not so much that stocks had better returns. Everyone knew in the long run they had better returns. But I think what they didn't know is that once you go to longer periods, the relative volatility of stocks goes down. In other words, it was not a random walk in the long run. In the long run, it had properties of what we often call mean reversion, reverting to the mean. And that trend line, which when my first edition came out, was 6.7% per year return after inflation. Even in the updated edition, it's 6.7% return after all the volatility we've had in 20 years. It's gone back. So it was mean reverting in the long run, which made the long run profile of risk relative to bonds much less scary than the short run profile of risk.
Now, let's just be clear here. By long run, you mean from 1800 to the present.
Well,
is that
but
right?
I was also looking at 20-year period, 10-year period,
Sure.
So 5, 10, 15, and the standard deviation of average returns went down far faster than the random walk theory would predict.
So the overall message is that investors ought to keep money in stocks for the long run.
Yeah, if you're in a long run orientation, and anyone saving for 401ks, IRAs, they're looking ahead to their retirement. The bulk of their assets should be in equities.
So I want to turn to April 1999, because you wrote an op-ed piece about the internet bubble. I don't think anybody was calling it a bubble at the time, but you did.
Yes. Well, actually, there was the April piece about our internet stocks overvalued out there ever, which came in April. My most famous timing piece was the following March. March 14th appeared as the lead op-ed and the Wall Street Journal. Big cap tech stocks are a sucker's bet.
Wow.
Now, people said, Jeremy, you were within 2 or 3 days of the absolute peak of the NASDAQ. How did you do that? And I said, it was damn luck. Absolutely. Don't think I knew it was the peak. I just knew it was crazy. And basically, actually, I based it on a lot of this because there was one chapter that I talked about the Nifty 50 of the 70s, and I said that no big cap stock really deserved a PE of over 50 or 60.
Why?
And they didn't grow. Once they got to that size, they couldn't grow enough at the far end to justify. Polaroid had the highest at 90. We know what happened to it finally, and many of the others. Now, of course, people talk about today, whoa, are we in a different world with Amazon and Apple and Facebook and a few of the others? Except for Amazon and a couple of others, really. I mean, Apple is a reasonably priced stock. I mean, what, 20 or less? It was 10 for a long time. It never got to the average tech stock at the peak in the bubble of the S&P 500. I'm not talking about the crazy internet stocks. Was 90 times earnings.
Wow.
And in fact, a lot of advisors were moving they said, we'll move to IBM, which is only selling at 50 times earnings. We'll move to Microsoft, only 50. That was considered conservative. So people who tell me today, Jeremy, isn't this like the 1999 bubble? I say, no way. We're nowhere as crazy as we really were then. I mean, I do know there's a couple stocks out there, but in terms of the overall market, nowhere.
And is it PE that you really looked at?
Yes, I really did look at. I did look at price earnings. I think that is very important. And in fact, when I'm giving talks today, it's PE or adjusted PE that I look at to project real returns on the market going forward.
So some of these themes came out in your follow-up book in 2005. Looking at
Future for Investors.
Future for Investors.
Yes.
And I love the full title. Why the tried and true triumph over the
bold and new.
The bold and new. It's a great title. Some of these themes came up in terms of growth traps.
Yes.
And you talk about some other themes as well related to the aging population and questions that when you present your results from your first book, you got these questions about, well, which stocks
Which
should I be investing in, and what about what's going to happen when boomers retire?
Right.
So how did you address those issues?
Well, it was very interesting. I started out that book, and I said, suppose in 1950 you're given the choice of two stocks, Standard Oil of New Jersey, which of course is Cummins and Mobil, and IBM, which is still IBM. And you could invest in either one of these stocks. And I'm going to give you an Aladdin's lamp, crystal ball. I'm going to tell you their earnings growth over the next 50 years, and both Standard Oil and the other. Which would you choose? Well, when I do that, IBM just beats them all the way. Everyone says, well, IBM. I said, no, the bigger, better returns were Standard Oil of New Jersey.
And why was that?
Because it had a lower price. And when you reinvest the dividends, from that lower price, or when the firm engages in buybacks at that lower price over long periods of time, that shoots you ahead. And that was a big surprise to me, because everything is earnings growth in Wall Street. And in the short run, yes, that is an important factor. But really, in the long run, a lot of it was its PE ratio, dividend yield became very, very important as the long run. And one thing that is often made of, and I talked a lot about it, the best performing stock, either from 1929 or almost every period, is Philip Morris. And people say, Philip Morris, how did that do? Well, for a 15-year period, everyone thought it was going bankrupt. It was selling at around 5 PE and had a yield of about 12%. Now, you're reinvesting the dividends when you do long-term returns. So you were, as long as that company didn't go under, the amount of shares you finally got at the end of that period, when it recovered to the old level, it shot above every other stock. And so it's sort of, when you explain it, people understand it, but it is counterintuitive. Those are a lot of the ones that I think, and one of the reasons why I think in the long run, at least from the historical data, value stocks did better is because of that reinvestment at a lower PE ratio in the long run tends to get higher.
So, that idea sounds a whole lot like what Benjamin Graham once
Yes.
said about, in the short run, the stock market is a voting machine, and in the long run, it's a weighing machine.
Right.
So what about the aging population? So
Yeah,
is
that
a
was
reason
another.
to-
Everyone said, what happens when all the baby boomers retire? Everyone's going to be selling, and there's not enough young people there that's buying. And what I pointed out is, as long as we have growth in the emerging markets, China, India, or whatever, they're the young people. Now, of course, China, because it's one-child policy, is not getting as young as it should. India, and then perhaps the Middle East and Africa, but they will be the savers. So I did a long-run model and really showed that we could support markets into the 21st century by having the growth of the emerging market economies come up, and you don't have to be what's called a demographic pessimist about what's going to happen to the equity prices.
Again, your macro training helped.
That was
out there.
exactly, I wanted to try to tackle that. It worried me too, because I knew there was a population bulge. I was a baby boomer, and I knew that we were going into retirement. We were going to be selling our portfolios to finance our consumption. Who was going to buy it? Are they rich enough?